When we talk of group of companies, what is a group of companies? What is a group of companies? What's a group of companies? What's a group? What is a group of companies? Now, the first thing that I would want you to appreciate, ladies and gentlemen, according to IFRS 10, according to IFRS 10, a group of companies, or a group basically equals who? A group equals the parent company. You must have just one parent. Parent plus who? Plus its subsidiaries. Parent plus its subsidiaries. There could be many. Subsidiaries can be many, but parent company only one. Only one. Great. Now, what is a subsidiary? A subsidiary is a company that is being controlled by a parent. According to IFRS 10, a subsidiary is any company which is under any company under the control of who? Under the control of the parent company. 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 So whenever you hear of sub means what you're part of. Part of. This is basically like what IFRS 10 tells us. A parent and a subsidiary are basically one economic unit. Because when a parent says match right, automatically the subsidiary has to follow that. You know, like your own son. Especially when they are in primary school. When they are in primary school, kabla waanze kumea pembe. Ukimwambia in this case here, sit there, read. They read. So basically they are in your full control. They are under your control as a parent. And the same case is applicable to subsidiary companies. You see, for subsidiary companies, what will happen is that the parent company will have a say as regards to what? As regards to who sits in the board of the subsidiary company. Who sits in the board of the subsidiary company? Which directors? How many directors do we take to the board of these subsidiary companies? Automatically, the subsidiary company will be under our purview, will be under us. So any company that the parent company is in control of, it will be called who? A subsidiary company. So how do we get to know that this company, we are really controlling the company? It depends on so many factors. It could be on the basis of what year? Shareholding. It could be on the basis of shareholding. On the basis of shareholding. And as we're going to see, on the basis of shareholding, any company where the parent company has got at least, not at least, but more than, where we have more than 50%, more than 50% of its equity shares, then automatically that company, we are able to control it. Equity shares are the ordinary shares. So on the basis of shareholding, any company that we have more than 50% of its equity shares, automatically we are able to do what? To control it. Because I mean, it is equity share, the number of equity shares that you have, which are going to give you, for example, positions in the board. Because board positions, ladies and gentlemen, are things in this case here that we get through, for example, voting. Remember, it is only equity shares that will give you what we call the voting power. What will give you the voting power? So in terms of shareholding, always, we shall be saying that that company, ladies and gentlemen, where we have more than its 50%, more than 50% of its shares, ordinary shares, then that company will be called who? Or rather a subsidiary company. But now listen, here we are, and I've given you this example before. We have here Chow, Catherine, Agnes, Abdi Shukri, Mohammed, and the rest. We contribute how much each one of us? 10 million Kenya shillings. When we contribute 10 million Kenya shillings, each one of us, of course, because we are rich, we can afford that, 10 million. We just make a clarion call, but we want each one of us to give us 10 million. I'm so sure by Friday next week, we shall be having this money, about 1 billion Kenya shillings. Yes, by end of next week. Now, when we get this $1 billion, we decide we go and invest this money in Nairobi Hospital. Of course, Nairobi Hospital is quite pricey. It must be an expensive hospital, right? So we go and buy. Assume that we buy 80% of that company. But who are we? We are accountants. We've got no knowledge at all whatsoever on how a hospital should be run. So we have bought, this group of accountants has bought 80%, of Nairobi Hospital. All right. And then now we have these other guys who will take the smaller percentage. These other guys who take the smaller percentage, of course, you may say that they are not in control. The one who has a bigger percentage, 80%, is the one who is in control, right? So the 20% investor is going to be referred to as non-controlling interest. He doesn't have control. So it's a non-controlling interest. But now listen. I want to make a very important point, but that really is not even about numbers. It is about substance over form. It's about substance over form. It is about what do we have on the ground, right? How does the reality look like? Listen here, we have 80%, but the 20% team is comprised of who? Senior doctors, pediatricians, surgeons, etc. So we sit down as an 80% shareholder and say, hey, we don't have really the technical know-how of running this hospital. We are going to cede our running affairs to this smaller group. We write to them, appointing them. We tell them that you guys go and sit in the board. All of you sit in the board. And perhaps for our case, we shall only have one person. Let me check your names and see who looks good here. So one person that we shall appoint to the board. And maybe them, we give them how many positions? 4. So then who is running the affairs of the company? Who is controlling the affairs of the company? It is this person who has got what here? The smaller percentage. So as we're going to see, ladies and gentlemen, later on, control really is not just about numbers. At times we'll be told that A has bought 40% of company B. And after buying 40% of company B, because of this, and they'll give you very many reasons, company A has been given exclusive powers to run company B. Even with 40%, the moment you are given exclusive powers here to run a particular entity, then that entity is under your control. And any entity that is under your control, regardless of the shareholding that you have, automatically that company becomes your subsidiary. But as we get started, we are saying that our subsidiaries will be those companies as we start. Our subsidiaries will be those companies whose shares we happen to be having their shares more than what here? 50% of their shares, 50% more, 50.00. Majority, you are the one who has the bigger side of the stick. Now listen. So we have 2 companies here. Which companies do we have? We have a company called Company A. So this Company A, ladies and gentlemen, has bought Company B. Company B has bought what percentage? 60% of Company B. So A has got 60% of Company B. Because this 60% is more than 50%, then automatically B, or rather A, will be a parent company. A will be a parent company, and a B will be a subsidiary. B will be a subsidiary. But you see here, because you only have 60%, there must be another stakeholder, another investor. This other investor will be having what percentage? Somebody who is following. This other investor will be having what percentage if you are following? 40%. What name do we give to this other investor? What name do we give to this other investor? What name do we give to this other investor? NCI, non-controlling interest. You guys are geniuses. Non-controlling interest, non-controlling interest. Now listen, remember, each of these companies here will do their own separate financial statements. The parent company will be having its own set of financial statements. The same case, subsidiary is applicable to the subsidiary. The subsidiary will also be having its own financial its own financial statements. But at the end of the year, because the 2 companies here form what we call one economic entity, will need to put those financial statements together. So these two financial statements here must be combined to give us what we call consolidated. The consolidated financial statements. The consolidated financial statements. But now, ladies and gentlemen, listen and listen to me very well. How do we do these consolidations? It's very easy. It's very easy. The easiest thing ever. The only thing you're supposed to appreciate here is that the two companies are forming one block, one economic entity. And we shall only be appreciating things that come from third parties. Any business done by these two companies, for example, A has sold goods to B. A has sold goods to B. Just don't recognize that sale. If it has been recognized by any of the two companies, cancel that sale because that sale is intra-group, inside group. That sale is fake. That sale is fake. That is just simply like moving goods between stores. Moving goods between stores, yes, moving goods between stores. Now, ladies and gentlemen, before I show you how this question of last semester was so important to us, I would want to open this question that was tested, this question that we got last semester. This question that we got last semester. No, first of all, I'll do a simpler one. Let's do a simpler one. Great. Okay, so this is the question that I would want to. Great. Please confirm to me whether you are able to see my paper. Are you guys able to see my paper here? Let me make it a bit wider. Great. Are you able to see? Great, great, great. Yes. So I would want to do this question here before I do the question that came to us last semester. Last semester, this is a very important question. Each one of us has it. Each one of us has this. Each one of us has this question. Each one of us has this question. So we are told here, on 1st January 2021, Singapore company paid 90,000 for a controlling interest of 80% in Marina Bay Company's equity when the retained earnings of Marina Bay Company were 25,000. The summarized statement of financial positions as at 31st December 2012 are as follows. So I can see Singapore, I can see Marina Bay Company there. Marina Bay Company there. Great. So they want me to do something very simple. They want me to give them here the consolidated statement of financial position, just like last semester. They wanted us to give them a consolidated SOF, for Singapore what year group, for Singapore group. Ladies and gentlemen, then how do I do this question? These are very straightforward questions. The very first thing that you need to do here is to give us a group structure. So come here and give us a group structure. How is this group structure? Who is the parent? Who is the subsidiary? Do we have any associates? Do we have any joint ventures? Let's see. So we have a company here called who? Called Marina Bay. We have Singapore. Singapore is the company. major company, Singapore. So Singapore acquired 80% of a company called Marina Bay. Marina Bay. So you see, 80% is so big. 80% is a very big shareholding. It means for sure that Marina Bay is under control of Singapore. So Marina Bay becomes group. This becomes a subsidiary. But remember, it's not a wholly owned subsidiary. No. It's still, ladies and gentlemen, we have what is some other investor. It's not 100% owned. So if you have another investor, you must come and give us the name of the other investor who now is not in control. Just an investor, the small investor who is not in control. Who in this case here will be having what percentage? Who will be having 20%? Who will be having 20%? So NCI is 20%. NCI is 20%. NCI is 20%. Now, once I finish doing this, the next step for me, ladies and gentlemen, will be to come here and provide something so sensitive. Appraise the net assets of the subsidiary. You must understand, this subsidiary you're acquiring in terms of assets. How much is it worth? So the worth of, give us here the worth of the subsidiary. And remember, the worth of the subsidiary is normally computed using what we call the net assets approach. So basically, give us the net assets of the subsidiary. Give us the net assets of the subsidiary. So how do we get the net assets of the subsidiary? So to get the net assets of the subsidiary, we are told here by IFRS 10, consolidated financial statements, to measure these net assets as earnings, acquisition, and as earnings, reporting, as at acquisition, and as earnings, reporting, as at acquisition, and as at reporting. So you measure the worth of these assets as at acquisition when you acquired it, and as at the reporting date. Very important for us to appreciate that, as at acquisition and as at the reporting date. Now, please listen. When they mention these words, net assets, what comes to your mind? I know what comes to my mind. The worthiness of a subsidiary will always be measured using net assets, which are equivalent to equity of a company. Equity of a company, yes, which are equivalent to equity of a company. Equity of a company, the owners. What the owners are in this case here own. The owners. So again, I'm coming back. Today, I will be on your case so seriously. When you talk of equity, are you able to see the equity components? Is there anybody who is able to tell us what the equity components are? What the equity components are? What the equity components are? Are you able to see the equity? Are you able to remember the equity components? Are you able to remember the equity components? Are you able to remember the equity components? Yes, Susie, we have ordinary shares. Ordinary shares, I like that. We have retained earnings, I like that. The equity components, share premium, retained earnings, yes. Fair value adjustment, yes. So we have here ordinary share capital. So we have here the ordinary share capital. Actually, I can even write them fast. We have the share premium. Share premium. We have what we call the retained rule, the retained earnings, the retained earnings. We have in this case here the fair value adjustment, fair value adjustment. So these are basically the equity components. These are basically the equity rule components: ordinary share capital, premium, retained earnings, and the fair value adjustments. Of course, there will be depreciation on fair value here. Very important as well. Depreciation on fair value adjustment. This is the fair value adjustment, like that. Depreciation on fair value adjustment. Depreciation on fair value adjustment. Depreciation on fair value adjustment. So I'm trying to measure the worthiness. The worthiness of this. Is it worth really? Or we are going to waste our money here? So please go to the income, not income, but balance sheet, the balance sheet of the subsidiary. balance sheet of Marina Bay. This is the Marina Bay subsidiary balance sheet. You'll be able to see the equity shares. So remember, whatever we have here are at the date of reporting, 31st December 2012. So on this reporting date, is there anybody who is able to see the equity share capital at the reporting date? Yes, I can see 15,000. So equity share capital here at reporting, 15,000. I can see retained earnings at reporting. Retained earnings at reporting, I can see them here, 40,000. Retained earnings at reporting, 40,000. There is no share premium. There is no share premium there. Great. So look at what I've done here. I'm making reference to the date of what year? Reporting, as at the reporting. 15,000 was the ordinary share capital given in the balance sheet of the subsidiary. We have 40,000. These are the retained earnings as at the reporting date. Remember, we report through our balance sheet, through our financial statements, right? Fair value, I'll be able to get. But now there is one thing that I can easily feel here. No, let me even get the fair value adjustment. Let me get the fair value adjustment. What are they telling us here about fair value adjustment? What are they telling us? I can go very fast and read about this. Yes. So they're telling us here, at the date of acquisition, the fair value of the NCI of Marina Bay Company was measured at, I'll do this later. I will do this later. This will come in later when I'm measuring goodwill. Note number 2, for consolidation purposes, at the date of acquisition, the fair value of non-depreciable land of Marina Bay Company exceeded its carrying value by 25,000. So, ladies and gentlemen, they are talking about fair value. The fair value of non-depreciable land exceeded its carrying value by 25,000. So in this case here, which one is bigger? Which one is bigger? The one that is bigger here is the market value. Market value is the same as what? Fair value. Market value is the same as fair value. So fair value is more than the book value. Remember, carrying value is the same as book value. So then this is a revaluation upward. Whenever the market value is higher than the carrying value, as an accountant, you'll be told to push your book values up. So it's a revaluation upward. It is a revaluation upward. So fair value at reporting, fair value will be the same. At reporting and at acquisition, fair values will always be what? Will always be the same. And since this is land that is non-depreciable, since this land which is non-depreciable, you can't depreciate, so depreciation on the fair value here will be dash through. Because it's land, you're not going to depreciate this. You're not going to depreciate it. Now, can somebody in this case here talk to us this afternoon? What do you think of ordinary share capital of this Marina Bay as at acquisition? As at acquisition, what do you think of the ordinary share capital as at acquisition? It is the same, isn't it? The same. Because share capital of a subsidiary, after you acquire it, it rarely, I've never gotten even a scenario where it's even in practice, and I normally practice this group reporting where I work, this group reporting. It is normally the same. It's normally the same. So ordinary share capital is normally the same. The same case with this premium, but in this case, we don't have premium. What about retained earnings at acquisition? That will be given. That will be given. Retained earnings at acquisition will be, and even if it's not given, it's very easy for you to do what here to compute it. It's very easy for you to compute it. It's very easy for you to compute it. They'll tell you. Like here, they have told us. On 1st January 2021, Singapore company paid 90,000 for a controlling interest of 80% in Marina Bay's company equity. When the retained earnings here, when the retained earnings of Marina Bay were 25,000. So retained earnings at the date of acquisition, 25,000. Great. 25,000. So here we have retained earnings at acquisition, 25,000. So that is it. Please come and give me the total. 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 Give me the total of the equity components as at acquisition. And then as at reporting date. Give me the total. Somebody talk to me this afternoon. 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 So according to Lenny, 65,000. Reason it is 65,000. 65,000. How about our net assets as at reporting? 65,000. At reporting 80,000. At reporting 80,000. Thank you and thank you very much. Thank you and thank you very much. Great. Now, ladies and gentlemen, remember as I'm measuring worthiness of this subsidiary, anytime your net assets are growing, like now we can see the net assets growing here. Could you kindly give me the difference? Could you kindly give me the difference? Kindly give me the difference here. Kindly give me the difference. Is there somebody who is able to give me the difference between the net assets? Give me the difference. And remember, the difference, we shall always give it a very special term. It's called the post-acquisition profit. It's called the post-acquisition profit. We shall call it post-acquisition profit. Difference between the two is what we call the post-acquisition profit. And somebody is telling me that this is 15,000. This is 15,000. Now, what do you know about profits? Once you get this post-acquisition profit pop, what do we do with it? You apportion it to the two owners. You divide it. You apportion it immediately. Pop. Whenever you get you share out. Apportion it. Apportion it. So this pop, we have a pop. We have a pop of 15,000, but we know that we have got two owners. We have a parent who is controlling, and then we have NCI. So the parent company has got what percentage? Parent company has got 80%. NCI is 20%. So 80% of 15,000 gives me what figure? 80% of 15,000 gives me what figure? 80% of 15,000 gives me what figure? So whenever you get this post-acquisition profit, which is the difference between the net assets, always share it out. So 80% of 15,000, David Kamaru tells me that this is 12,000, like that. And then 20% of 15,000 gives me how much? This gives me 3,000. By the time you reach here, you'll have gotten very many marks. Very many marks. So what have I done? I've looked at, ladies and gentlemen, I've looked at the structure, the group structure. Number two, I've been able to measure the worth of my subsidiary to the extent that I've realized that this subsidiary has made some profits after acquisition. So I've been able to generate the PAP. And once I generate the PAP, then I should be able to share it out to the two owners. If it was a 100% owned subsidiary, then NCA would have gotten 0. The parent would have gotten 100%, the whole of it, the whole of it. Now, from there, ladies and gentlemen, I would want to know the worth of NCI at reporting. The worth of NCI at reporting. Give me the worth of NCI at reporting. Can I rub this? 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 They are not talking to me. I don't know why. They're not talking to me. They are not talking to me. They are not talking to me. Great. Great. So in this case, I would want to know the worth of NCI worth of NCI at reporting. At reporting. Very easy. Remember, NCI is a non-controlling interest. Non-controlling interest. So how much are they worth by the end of what year? The reporting date. So start with the NCI at acquisition. NCI at acquisition. So is there somebody who can tell us when we were acquiring this NCI, this company, NCI had a fair valuation of how much? NCI, you can see here. We're told here that at the date of acquisition, the fair value of NCI of Marina Bay was measured at 20,000. 20,000. So NCI at acquisition, 20,000. These guys' worthiness has gone up. Yeah. Give them share of their share. Share of PAP. NCI's PAP. So NCI's PAP, NCI's PAP was coming to how much? NCI's PAP was coming to how much? 3,000. 3,000. So please, here, 23,000. So, ladies and gentlemen, this automatically is our NCI at reporting. This is our NCI at reporting. NCI at reporting. Now, from ladies and gentlemen, I don't know whether first of all we are together up to here. Are we together up to here? Group structure. Number 2, give us the worthiness of the whole subsidiary. From there, come and look at how our NCI doing in terms of what year is their value increasing, like that. Great. Now, from there, ladies and gentlemen, I would want you to take me straight away to the group retained earnings. This is so important to me. The group retained earnings. Is there anybody who is able to give us the group retained earnings? Is there anybody who is able to give us the group's retained earnings? The group's retained earnings. Is there anybody who is able to give us the group's retained earnings? The group's retained earnings. Is there anybody who is able to give us the group retained earnings? Because that is one area, again, which knocks so many people down. The group retained earnings. The group retained earnings. This is one area, if you understand it well, you will never go wrong. So the group retained earnings, I can see it here. You can see the retained earnings there, right? Singapore has 100. Marina Bay has got 40,000. So come and give us the group's what here, retained earnings. Very important. The group retained earnings. So we have here the group retained earnings, the group retained earnings. So this one you can easily confuse. I've always seen students doing this in CASNET, where students will come and take like group retained earnings. They take the one of the parent plus the one of who? The subsidiary. You get a 0, and then you keep on wondering how comes I'm failing this paper semester after semester after semester after semester. No, it's because you have not yet understood these concepts very well. Ladies and gentlemen, for the group's retained earnings, what do we have? For the group's retained earnings, you take the parent retained earnings. The parent retained earnings, which I can see, remember, parent is Singapore, right? Is Singapore, right? So in this case here, Singapore, the parent is Singapore. Is Singapore. I can see the retained earnings are 100,000. And then I add, yes, add in this case here, share of PAP for the parent. So the parent was getting what PAP amount? Yes, the parent was getting what PAP amount? 12,000. So that is it. So then this gives us 112,000. Lastly, you give us the goodwill. The goodwill. Goodwill at acquisition and at reporting. So goodwill at acquisition and reporting. Goodwill. Remember, according to IFR-3 business combinations, goodwill, if you search there, they'll tell you that goodwill is at premium on acquisition, where we take the difference between the consideration paid and the net assets of the subsidiary. So basically, we are saying that goodwill equals who? Equals consideration paid minus the net assets of the subsidiary, consideration paid minus the net assets of the subsidiary. And then remember, when we talk of consideration paid, we are looking at the parent and the NCI. Parent plus who? NCI. Parent plus NCI. Parent plus NCI. The consideration both paid to be able to acquire the entire company. Now remember that whenever you consider parent and the NCI's consideration, Whenever you consider parent and the NCI's consideration, then this method will be called the full method. Because now this is full consideration, full method, full method, full method, full method, because this is what here somebody, full consideration, because this is full, you've gotten consideration from the two parties. Yes, remember for group retained earnings, you take the one of the parent only, plus what here somebody, the share of PAP. You can't bring the retained earnings of the subsidiary direct, not unless the subsidiary is 100% owned, right? You can't just bring that directly. There is an abracadabra. Yeah, you have to take it this way. You take the parent, retain the earnings, add the share of what here, PAP. Add the share of PAP. Great. So I was trying to explain something here. When it's parent and the NCI's consideration, then that becomes what here somebody, full method. What if, for example, it was only consideration of the parent? So when it's only consideration of the parent that has been given, right, then your goodwill will be what here? Partial, what we call partial method. Partial because you have got only consideration from one owner. Consideration from one owner. But we'll come back to that. That should not worry you at all. This is the easiest topic, and it's a topic that you will like most. If you like it, you will end up passing. Passing very, very easily. Passing very, very easily. Now, let's look at the method that we have here. Very easy, very easy. Very easy, very easy. Very easy, very easy. So in this case here, we have goodwill. So we have here parent consideration. Parents consideration. So from your paper, the parent paid how much? The parent paid how much from your paper? Parents consideration. The parent paid how much? To see whether you're together. The parent paid how much? 90,000, right? The parent paid 90,000. The parent paid 90,000. How about in this case here, fair value? Fair value of NCI at acquisition. Remember the NCI, they bought shares. On the date of acquisition, then they bought shares. And their shares were valued at that particular date, and we know how much their worth was at the beginning. The fair value of NCI at acquisition, they have told us. They have told us here. They have told us here. At the date of acquisition, the fair value of the NCI of Marina Bay Company was measured at what year? 20,000. So the fair value here is 20,000. So you add that. So you just 110,000. So this is the total consideration. Total consideration. And because you have added the two considerations, then this becomes full method. You can even write for the examiner. This is how you demonstrate both broad and a deep understanding of the subject. Right for him, but this is full method. You scare the examiner. You scare the examiner. You scare him. Full method. 110,000. And then now you come under less the net assets of the subsidiary. Less net assets of the subsidiary. Net assets of the subsidiary at acquisition. Is there somebody who is able to see the net assets of this subsidiary at acquisition? Is there anybody who is able to see the net assets of the subsidiary at acquisition? These guys are not looking at that table where we were looking at the worthiness of the subsidiary. These guys are not looking at that table. These guys are not looking at that table. There's a table where we have net assets at acquisition, net assets at reporting. NCI share of profit. That one we took a long time ago. You don't remember where we took? We can't bring NCI share. You see, this goodwill you're getting here is goodwill at acquisition. It's goodwill at acquisition. So that time there is nothing real that has accrued that you would want to come and share with them. No. So it is 65,000. Like that. And then you'll be able to give us goodwill at acquisition. Goodwill at acquisition. 45,000 I'm being told by Moro. 45,000. 45,000. In this question, we never had any impairment. If we had any impairment loss, we'd have subtracted here to get goodwill at reporting. To get goodwill at reporting, which in this case here will still remain 45,000. 45,000. So are we there? Are we here? Are we here? Are we here? Are we together? Great. We can't, I've never seen even a single situation where we bring the NCI, not unless you're looking at now which one. Just try to master first of all, because you're just starting the topic, just master the concepts like this, right? Just try to master the concept like this. You'll really confuse yourself with so many issues in between. It's a straightforward thing. It's a straightforward thing. It's good to ask questions. I'm not refusing, but just try. We are still at a very basic level. We haven't gone to step acquisitions. We're still at a very basic level. Great, great. Now, ladies and gentlemen, after this, then I'll ask myself whether these particular entities did any business between themselves. Was there any business? Was there any business that was done between these two entities? That the business is fake. And if there was any profit earned out of it, we should cancel. Let's see whether there was any business. We are told for consolidation purposes, at the date, this does not lead to any business. At the reporting date, Singapore company owed, great, no worries. So there is nothing like unrealized profit going to be calculated here, right? This particular intra-owing, we shall be able to deduct it later. This intra-owing, we shall be able to deduct this later. So then we are at home. Let's do a consolidated what year? Statement of financial position now. So the last thing now we'll do is a consolidated statement of financial position. Very easy. Consolidated statement of financial position. Consolidated statement of financial position. You will overcome. Consolidated. Or financial position. To consolidate is to put together. Mayoma, I don't understand you. If there was no NCI given at acquisition, now I understand that question. If no NCI is given at acquisition, for example, what would have done, because it's partial method, would have come here and said parents consideration, like the 90,000, and then I will less the net assets. But now it will be the net assets of the parent alone. Remember, the parent has got what percentage? 80%. So would have taken 80% of 65,000. Put it here. And then we end up getting goodwill, which is what here, what we call the partial goodwill. Goodwill attributable to just one party. But we'll come back to this. We just do this. For now, let's drive the question all the way to the end. Great. Okay, network issue. Network has a problem. Is it my network or your network? Is it my network or your network? It must be your network. It must be your network. Oh, what do you mean? Are you guys experiencing network problems here from Walimu? Mine is okay, Apana. We are okay. We are okay today. Today we are okay. Thank you so much. Now, ladies and gentlemen, from there, we shall come here right away and do this consolidated financial statement. So we are consolidating. To consolidate is to add side by side. So in this case here, we have consolidated financial statement. So we start right away. We start with investment in Marina Bay. So we have the first non-current assets. So mentioned there non-current assets. non-current assets. The first non-current asset there is investment in Marina Bay. So remember, Marina Bay is our who? Our subsidiary. Our subsidiary. So if it is our subsidiary, we can never have it as our asset in our books. Whatever investment you make in your subsidiary can never be recognized as an investment because those are internal arrangement. That's a fake arrangement. And I gave you an example. If, for example, today you are to sponsor, you are a good husband, you sponsored, in this case, your madam, through her degree, through her master's, even she has gotten a PhD, courtesy of you investing in her. But remember, you are one economic entity. So you can't come in this case as a good husband every time you're reminding your wife that, you know what, I took you to school. No. That's your own investment, right? Just like how you cannot, in this case, keep on counting the fees that you pay for your children at school. These guys, when they grow up, they can even decide to dump you into an old home, people, or rather a home for the old people. They throw you away and you can't take them to court, right? So whenever you are investing in your people, that is your own investment. That's a fake thing. The only thing that you would expect in this case here now straight away, or rather which you can count, is what we call goodwill. So investment in subsidiaries will always be replaced with one terminology called what your goodwill. If it's investment in an associate, that one I'll carry it in my consolidated books, investment in because an associate is a distant cousin, is a distant relative. But investment in a subsidiary, we shall never have that one because that is an investment within the group really. So investment, because of your own knowledge, this is investment in Marina Bay, investment in subsidiary. It's mentioned there just in your books that this will be replaced with goodwill that we computed. Will be replaced with what? Anytime you see investment in your own subsidiary, always remember that investment in your subsidiary will always be replaced by what here? By goodwill. By goodwill. By goodwill. Okay. So in this case here, replacement in Marina Bay subsidiary, how much was the goodwill? How much was the goodwill? So straight away here, I will recognize goodwill. Goodwill of how much? 45,000 megabytes. 45,000. So I'm being corrected there that never use the word wife. Use madam or her highness, isn't it? Her highness is even better. 45,000. Great. Now from there, you're following this schedule here. You're following this schedule here. So property, plant, and equipment. So I can see 30 and 30. I'm adding, I'm consolidating. It's about adding. So PPE. So I'll come and mention here property, plant, and equipment. Property, plant, and equipment. I can see the parent has 30,000. The subsidiary has 30,000. But remember, we had some revaluations on the road. We had some revaluations on the road that has to be captured afresh here. This one here. For consolidation purposes, at the date of acquisition, the fair value of non-depreciable land of Marina Bay Company exceeded. It's carrying this 25,000 is in the notes. It's not in the financial statements. Now we need to bring it. And because it is a revaluation upwards, I told you when fair value is up, fair value is the same as market value. When it's more than the carrying value, you as an accountant will be asked to push higher the value of your assets. So it's a revaluation upward. So I'll come and add here 25,000. If there was any depreciation, I would have subtracted. But now remember, there is no depreciation here. So then can somebody give me the total PPE here? We write here. Total property, plant, and equipment, 85,000. Thank you so much. 55,000. Now we are continuing. We are pushing on well. All right. Now from there, ladies and gentlemen, I can see we have the next thing here, known as group. There's really nothing there. It's current assets. So we have current assets 30 and 30 as well. Current assets 30 and 30. So current assets. So I'll take the parent has got 30,000. The subsidiary has got 30,000. We add. Later on, I'll be making some adjustment. I'll just say minus here. I'll be making some adjustment later on. For now, I would just want you to come and write here total what here? Total assets. For now, just want you to mention their total assets and don't pick your calculator. Don't pick your calculator yet. Don't pick your calculator yet. Don't do that. Don't pick your calculator yet. Yes, there are times in this case here we have a downward revaluation. Yes, if it's a downward revaluation, what do? You subtract here and add back the depreciation. You add back the depreciation. Great. So don't pick your calculator. Later on, I'll be subtracting something here. So we go to the equity and liabilities. So mention there equity and liability. So under equity and liabilities, what do we have here? Under equity and liabilities, what do we have here under equity and liabilities? So we start with the equity shares. Equity shares. What do you know about equity shares? Hey, you, my friends. Equity ordinary shares. What do you know about them? What do you know about them? Equity shares. What do you know about them? Can somebody tell me? Can I come and take 25,000 plus 15,000? 25,000 plus 15,000. Can somebody do that? Can somebody do that? Can somebody do that? No, you take the one of the parent only. Equity shares and share premium, always take the one of the parent only. Always. Just write like that inside here. Parent only. Parent only. Parent only. You take the one of the parent. Thank you very much. Always. You take the one of the parent. You take the one of the parent. You take the one of the parent. So in this case here, equity, I can see parent, who is Singapore, is 25,000, a free mark. Free mark. After that, ladies and gentlemen, I'll come and pick retained earnings. So we have retained earnings. Retained earnings. So retained earnings, what do we have under retained earnings? Retained earnings, we calculated the group retained earnings. You guys can remember the group retained earnings, I'm so sure. You can remember the group retained earnings. I'm so sure you can remember that. The group retained earnings, I can. Okay, so the group retained earnings, what do we have here? Can somebody give us that figure? Group retained earnings, we have 112,000. This was computed, 112,000. Is there any other thing that is normally brought under equity that you guys are able to remember? Is there any other thing that is normally brought under equity as an equity component? There is something else that so many students forget. I don't know why. NCI. Thank you so much. So we have here non-controlling interests. Non-controlling interest. So non-controlling interest, are you able to remember this figure? We did a computation. We did a computation of non-controlling interest. Over how much? If you're able to remember non-controlling interest, 23,000. Thank you so much. Great. Super. So after that, now we can go to the liabilities here. So liabilities are in a mambo mengi. Liabilities, I'll only pick the liabilities given there. So the liabilities given there, we have, ladies and gentlemen, 25,000 plus 5,000. But remember now there is something here. And this is why I told you to mark this very well. There is something here. That by the end of the period, we had an internal owing. Singapore company owed 5,000 to Marina Bay Company. And the two companies, ladies and gentlemen, are joined together. They are the same thing. They're the same thing. And I keep on giving you these examples really, so that you can appreciate. But at the end of the day, it's like most of you, again, don't appreciate them. You don't appreciate them. So and I'll always tell you, for example, if come tonight, my madam tells me, you know what, my husband, I need 100,000. So if I have the money, I will advance to her. But do you think that in my books, it will be good for me to keep on carrying that loan, that amount as a loan given to, as Terry told me, my madam? Do you think that money will ever be paid back? Do you think that money will ever be paid back? Never, never. And that is why intra-owings must always be deducted. Why? They are fake owings. You will never get that money. Forget. So this intra-owing, go to the liabilities and subtract it, and also subtract it from the receivables. Never on earth, yes. Also from the receivables, because you see, one company is saying, I expect to receive from Marina Bay. So from one company's perspective, it's a receivable. To the other company's perspective, it's a what? It's a pay. So always remember to subtract it from payables and receivables. This fake inter-owing, the fake inter-owing, always remember to subtract it from you know, receivable is under current assets. So come and mention here minus 5,000, minus 5,000. So could you kindly, ladies and gentlemen, in this case, say, give me this figure now. Please give me this figure now. And as you give me these figures, what if I was the one to borrow from my madam? Will she write off the amount? What if I was the one to borrow from my madam? Will she write off the amount? Or I have to pay? Niachama. 55,000. So this is 25,000. So then could you kindly give me the total here, please? Please give me the total here. It has to come back with interest. Boy child has many issues. So 185,000, and this is 185,000. So this is total equity and liabilities. Total equity, and liabilities. Total equity and liabilities. So you can see that for sure the boy child is under siege. And that is why you get so many men during our retirement. We get into so many problems. Ndio maana nafaa pia mwanaume najipanga. Great. So then I would want us straight away to look at this question that was tested last semester, August 2022. August 2022. We have the paper. I'd given you instructions from the beginning. I told you guys, you need that paper. Is there somebody who has that paper? I had it. Great. This was a very straightforward question paper. If I'm the one who was doing this paper, I would have picked not less than 80% in a very short span of time. Because most of you don't fail because you are stupid, no. Most of you basically fail because of what year? You fail because you don't know that AFR is a speed test exam, speed test. So we get somebody, for example, takes 1.5 hours to do question number 1. I can even mark for you this paper right on the examination center. The moment I realize that this student has taken more than 1 hour to do like question 1, that student will fail. That is the first reason why so many students fail. Otherwise, it was a very easy paper, Bad taxation. We shall overcome. And you can see they gave us consolidated cash flow, right? Consolidated cash flow statement. And every year they do that. Those are 20 marks. 16 is as good as 20. And then, of course, question number 1 was consolidation, group reporting, 21. So if you're so good in my topics, 2 topics, you're assured of doing what you are passing. You're assured of passing. Great. So now let's read this question together. Again, you don't read a question as if you are reading home science. You must always start by reading the requirement. So required, determine the non-controlling interest in S Limited. B, consolidated statement of financial position as at that date. 14 months. 14 months. P Limited, a public limited company, has held a controlling interest in S Limited, another public limited company, for 1 decade. P Limited also has a significant influence over A Limited, right? A public limited company. All the companies operate in the manufacturing sector. The draft financial statements of P Limited and S Limited are as given there, 30th June, with the reporting date. Well, as follows. So we have P Limited. Here, remember, the thing is that P has a controlling interest in S. Any company where you have a controlling interest, then this company called S is a subsidiary. The company called S is a subsidiary. Great. Yes, Consolata, here under the equity, we shall only take the figure of the parent for equity and share capital, only the parent, yes. Under investment, under the investment there, whenever you see, in this case here, any metric, they are talking about subsidiary. Subsidiary investment, subsidiary, you shall replace that with what here? With goodwill. We shall replace that with goodwill. Great. So we are told here, okay, so I can see non-current assets, PPE, like now investments in S Limited. I can't take this 13,000. According to what Consolidated is asking, investment in S Limited, because S is our subsidiary, I'll only put there goodwill. But investment in A is an associate. I may need to put this figure, but adjusted there. You know, you must adjust. You must add some post-acquisition profits, etc. Yeah, right. Then we have financial assets at fair value. This is a straightforward thing. We have current assets, inventory. We have trade receivables, cash and cash equivalents. We have total assets. So we start from here. On 1st July 2012, P Limited acquired 60% of the ordinary shares of S Limited for a cash consideration of 10,000. At acquisition, the fair value of NCI was 6,500 million. P Limited wishes to use the fair value method of accounting for goodwill. On 1st July 2012, the fair value of identifiable net assets in S Limited was 14,000. And the retained earnings of S Limited was 1,200. The excess in fair value was due to non-depreciable land. This was quite an easy examiner. He never wanted to disturb you so much. Or 2, on 1st January 2022, P Limited acquired a further 20% interest in S Limited for a cash consideration of 3,000. S Limited reported a profit for the year ended 30th June 2022 of 500, which accrued evenly throughout the year. Note number 3. During the year ended 30th June 2022, P Limited sold goods worth 2,000 to S Limited. Fake sales. That must be eliminated from my income statement, and any profit which is unrealized will also be removed. P Limited reports a gross profit margin of 25% on all its sales. Half of these goods were still in inventory of S Limited as at 30th June 2022. Note 4. Goodwill was tested for impairment immediately after the additional acquisition of interest in S Limited and was considered impaired by 10%. no impairment had been reported in the previous years. Note number 5, on 1st July 2015. The problem now to most students, once they reach like now in note number 5, they start, in this case, you're feeling things in their head, like a tongue twister. Now they can't even make the end from the beginning. They're lost there, right? If it's consolidation, these things are normal. They should never scare you. They should never scare you. Never, 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 right? So the moment you start hearing like it's a tongue twister, if can't I a tie? Where can't I a tie? Where can't I tie at unknown? These are straightforward things. So note 4, note 5, I mean, on 1st July 2015, P Limited acquired 30% over 1,000 ordinary shares of 10 each in A Limited. A Limited is an associate to us. A Limited, when the retained earnings of A Limited stood at 1,000, A Limited had no other reserves as at 1st July 2015. As at this date, retained earnings were that no impairment was deemed necessary in respect of the investment in A Limited. None of the group companies declared or paid dividend during the year, noise. None of the group companies issued additional shares. They want to scare you away. Can't I? Useless. Then they want me to give them the non-controlling interest. You can't start with non-controlling interest. There is a procedure. The very first thing you need to do is to give us the group structure. The group structure. So start by giving us the group structure. Start by giving us the group what here, the group structure. So start by giving us the group structure here. So these are straightforward question. Straightforward question. Let's see how we get here. The group structure. Yes, intermediate students can score everything. Yes. Even if you miss out some marks here, it will be because of the valuation of NCI. But all the things here, you'll be able to get all the things here. There are things. Valuation of NCI may give you a problem because there was a reduction in NCI within the year. That one will give an intermediate student some goosebumps a little bit. But all the other things, this student will be able to get. So, ladies and gentlemen, here we have our group structure. So we have our group structure. We have the group structure. We have the group structure. So group structure, what do we have? We have group structure. Very easy. We had a company here called you. We had a company called you. The name of the parent company is very important for me. The name of the parent company is P. So we have P Limited, which has S Limited, and then it happens to be having A Limited. So S Limited, we had a 60%. S Limited, we were told here on 1st July, we had 60% of S Limited. So in this case here, 60%. Before change, 60% before change, and then of course in this case here 80% because we bought 20% more, so 80% after the change. The dates are very important, but I can opt to leave them out this time around. So 60% was before change, and then now after change we decreased our shareholding by 20%. All right. So what will be of interest here will be the NCI. Remember NCI and ourselves here, we have to add 200%. So the NCI here, before the change, the NCI was 40%. And after the change, where we took more shares, where we increased our shares to 80%, after the change, the NCI was what here? Somebody was 20%. NCI was 20%. Now listen, remember this before change 60% was still more than 50%. So this became our subsidiary from the word go. So even this change falls under the change falls under what we call control to control. 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 We are still controlling this thing here before change, and even after the change, we are still the controlling party, the controlling investor. So it's control to control. We're moving from control to control. Remember the step acquisitions. In most cases, these guys will come and tell you that this company here was an associate. We had like say 30% of the shares, but in the year we bought like 40% shares to make now our shareholding 70. So in this case here, we have moved from associate status to control. No control to control. So this is a control to control position, and it's easier to work with control to control. Why is it easier to work with control to control? The goodwill working does not change. The goodwill working will remain the same. That goodwill you computed earlier on will remain the same. The only thing that will change now here, if it's control to control, is that there shall be a reduction in NCI. There'll be a reduction in NCI, but we shall get there. For now, we are saying we are moving from 60% to 80%. So we are moving between two control levels, to control to control. The same, you'll be told in this case here, for example, we had 90% of the shares of company cow, and then we reduced our shareholding, say to 60%. We haven't lost control. That still is a movement from a control position to a control. 90 to 60, both of them are above 50%. So it's control to control. That will be very, very important for us to appreciate control to control. Great. So then we are told here, we are told a very other important point here. This is where they mentioned to us that they increased the shareholding. On 1st January 2022, P Limited acquired a further 20% interest in S Limited. So it was 60. Now we have added 20, so 80%. Now we are told something very important about this company A. Company A. Is there somebody who is able to see information about this company called Company A? On 1st July, P Limited acquired 30% of the ordinary shares of whatever A Limited. So in this case here for A we only have 30%. So A we only have 30%. So A is 30%. So to demonstrate the broad understanding of the subject, straight away mention for the examiner that this is a subsidiary, this is a subsidiary, and this will become an associate. This will become an associate. If you remember, associates are those investments whose percentage holding is here, 20% up to 49.99%. These are associated companies. Associated companies. If you have any investment where the investment you've taken in that company, the shareholding you have falls between 20% up to 49.9999, slightly below 50%, then that will be an associated what year? So where is 30%? 30% is well in between. So automatically A is an associated company. A is an associated company. The moment you draw like that, you get one full mark, and that one full mark is quite great. It can easily make you see places that you've never seen before. Like where? Like where? Is there somebody who knows those places I keep on talking about? Is there anybody who knows those places I keep on talking about? A pass, but similar passes you've gotten you've seen that. You've seen that. ISPAC, yes. ISPAC, yes. ISPAC, yes. So to be able to get to ISPAC right away. Thank you so much. Ladies and gentlemen, please listen and listen to me very well. So the moment I reach here, I know I'll forget about the associate company. The company that I'm in love with here is the subsidiary. So the thing that I will do is to check straight away the worthiness of the subsidiary. Leave alone the associated companies and the joint ventures. The worthiness of the subsidiary. Give me the net assets of the subsidiary. That is the thing we should think about. That is a thing you should think about. Net assets of the subsidiary. Net assets of the subsidiary at acquisition, at reporting. You also had a change. I'll introduce that change later. For now, I just want us to keep with these two, at acquisition and at reporting. At acquisition and at reporting. So you are the ones who told me that equity components are share capital, share premium, fair value adjustments. We have retained earnings. Very important. So in this case here, yes. So Moru must have been my student. Moru must have been my student. In this case here, at the date of acquisition and at the date of what year? Financial statements. You want me to use this terminology that I used last year, Moru, with you? I'll not do that. We need to keep on using new terms every day. But I really appreciate it because I can see your memory is very good. It's very good. It's very good. It's very good. Great. Great. Thank you so much. Ladies and gentlemen, here we have our financial statements are here. S Limited. S Limited is the subsidiary. So you can see the equity. So the equity, we have ordinary share capital 10,000. Ordinary share capital. So we have the ordinary share capital 10,000 as reported there. All right. And then we have, ladies and gentlemen, share premium. Share premium. Share premium is how much? The share premium is 2,400. 2,400. And then, ladies and gentlemen, we have here, retained earnings. Retained earnings. At reporting retained earnings, what do we have as our retained earnings now? Retained earnings, we have 59.50. Retained earnings, we have 59.50. And then we have fair value adjustment. There must be some fair value adjustment. Fair value adjustment. So first of all, right up to here. And the moment you reach here, please give me a thumbs up. The moment you reach here, please give me a thumbs up. Remember, I've just copied this from financial reports. From financial reports, I'm just putting this down. From financial reports, I'm putting this down. Financial reports, I'm just putting this down. I'm just putting this down. Door and the DOF. Great. Done. Okay. Done. Thank you so much. Now, could you kindly tell me the figure of ordinary share capital that I should write at acquisition? What figure should I write here at acquisition, ordinary share capital? Tata, they'll always be same. Tata, the same. So we have here 10,000. This and this, the same, 2,400. But please don't be so much excited. Don't be so much excited and do the same with retained earnings. What do you think about retained earnings? Retained earnings at acquisition will always be given. Retained earnings at acquisition will always be given. Retained earnings at acquisition will always be given. Yes, we have the pre-acquisition or the ones that existed on the date of the acquisition. They give us this figure really. Let's search for it. At acquisition, the fair value of NCI in S Limited was 6,500. P Limited wishes to use the fair value method to account for goodwill. On 1st July 2012, the fair value of identifiable net assets in S Limited was this, and the retained earnings of S Limited stood at how much? Remember, 1st July is when we acquired, is the acquisition date. Stood at 1,200, 1,200. The figures are in millions. So in this case here, we have 1,200. Thank you very much. So retained earnings, 1,200 acquisition like that. Unfortunately, they have given us the total net assets at acquisition. The total net assets at acquisition. We can't get a better examiner than this. We can't get a better examiner than this. We can't get a better examiner than this. This is a nice examiner. I love this examiner. I love this examiner. So in this case here, on 1st July 2012, the fair value of the identifiable net assets in S Limited on this date, The fair value of the net assets here were 14,000. 14,000. So then what do you think in this case here will happen to the fair value adjustment? What do you think? What do you think shall we do to be able to get the fair value adjustment? Please write this in full. Fair value adjustment. This is fair value adjustment. What do you think do we need to do to be able to get the fair value in adjustment? The fair value adjustment. The fair value adjustment. Balancing figure. You take 14,000 minus this, minus this, minus this. Give me a figure. Give me a figure. Give me a figure. Give me a figure. You take 14,000 minus 1,200 minus 2,400 minus 10,000. So they're giving me 400. And they're telling me that this 400 is non-depreciable land. So there is no good reason for you to have like a fair value adjustment depreciation. No, because land does not depreciate. Land does not depreciate. Land does not depreciate. Land does not depreciate. Ladies and gentlemen, please listen and listen to me very well. They told us that the excess in fair value was due to non-depreciable land. The excess that you've gotten here in fair value was due to non-depreciable land. Due to non-depreciable land. So remember, fair value adjustment will always be the same across. So put 400 there. So please come and give me the total here. Please give me the total here. Give me the total on the other side. At reporting, then what do we have here at reporting? 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 So is fair value excess? Yes, fair value is normally it's like you know, because of that valuation, right? The difference 18,750. 18,750. So in this case here, then could you kindly give me the post-acquisition profit? Please give me the post-acquisition profit. Please give me the post-acquisition profit, 4750. So please don't subdivide this. I'll be explaining why we can't subdivide this the way we did with the other one, because of that change in between. There's a change in between that triggers something which is a concept that I would want to show you first before, right? May need some more time, but we shall overcome. So then today, what I would want you to do for me, just don't subdivide this. No much changes, but I would want like a whole 1 hour to teach you this concept of change, control to control. Control to control, for you to be able to know how we handle this part whenever we have that concept of control to control. So leave it there and then go straight away, ladies and gentlemen, and compute goodwill for us. Could you then kindly compute goodwill for us? For the remaining time, you could very easily give us goodwill. So I would want to give you 5 minutes. You compute goodwill. This is quite a low-hanging fruit, the goodwill. So go ahead and compute goodwill for us here. Goodwill. So please go ahead and compute goodwill. Goodwill. I don't know whether I have this solution for last sitting. There's a student called Lucy. Who sent me these questions. Goodwill. So you're getting goodwill. You're getting goodwill now. You're getting goodwill. You're getting goodwill. Very easy. It's total consideration minus net assets at the beginning. Total consideration minus net assets at the beginning. Total consideration minus net assets at the beginning. So give me the consideration paid by the parent. Is there anybody who is able to see that information somewhere? Is there anybody who is able to see that information somewhere? Consideration that was paid by the parent. Is there anybody who can see the consideration that was paid by the parent? The consideration that was paid by the parent. The consideration that was paid by the parent. The consideration paid by the parent. The consideration paid by parent. On 1st July 2012, P Limited acquired 60% of the ordinary shares of S Limited for a cash consideration of 10,000. At acquisition, the fair value of NCI, they've given us the fair value of NCI, so consideration paid by NCI. NCI, 6,500, and then of course we have here less net assets. Net assets at acquisition. Net assets at acquisition, which we have here 14,000. So the only figure that I would expect to get from you guys is this consideration that was paid by the parent. Is this consideration that was paid by the parent? Is there anybody who is able to recognize this consideration that was paid by the parent? Imagine they are not talking to me. I don't know why. When we were looking at these papers, the biggest mistake that I saw so many students doing, they came and took this consideration that was paid earlier of 10,000 plus this other consideration of buying, the extra 20%. That is the biggest blunder that they did. They took this 10,000 plus the consideration that was incurred in buying this extra 20%. Right. So in this case here, we should only work with what here somebody, we should only work with the original. When it's control to control, you pick the very original consideration. Why? Because remember the first goodwill that you compute is goodwill at acquisition. At acquisition, that extra 20% was nowhere. This goodwill at acquisition. So ladies and gentlemen, listen here. So then this automatically is 10,000. It's 10,000. So you take 10,000 plus this minus this, and even leave it that way. This minus this plus this minus this. Is there somebody who is able to give us goodwill at acquisition? Goodwill at acquisition is 2,500. And then now we are told here that there is what here? There is impairment. So less 10,000 plus this minus this, and even leave it that way. This minus this plus this minus this. Is there somebody who is able to give us goodwill at acquisition? Goodwill at acquisition is 2,500. And then now we are told here that there is what here? There is impairment. So less impairment loss. Impairment loss. Are you able to see the impairment loss percentage? There's the impairment loss percentage. 10%, right? 10%. There's a place here they mentioned something to do with 10%. There's a 10% goodwill. Note number. Is there somebody who is able to see that note number very fast? Is there somebody who is able to see that note number? Yes, note number 4. Goodwill impaired for additional condition of interest in S Limited was considered impaired by 10%. No impairment had been reported in the previous years. So this is 10%, 10% of 2,500, right? So 10%. So 10% of 2,500. So this will give us 250 to subtract. So you subtract and then be able to give us the goodwill at 40. So when it is control to control, our goodwill will not keep on fluctuating. The goodwill that you get at the very beginning, the only thing that will affect it will be what here somebody will be impairment. Will be the impairment. Will be the impairment. So in this case here, this gives us what here? 2250. And this is what I shall take to my group. After additional impairment was tested after addition.